Hello, welcome to this week's podcast brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker providing trading services in forex, stocks and commodities in multiple destinations. I'm Michael Hewson, and joining me once again is Pepperstone Senior Market Strategist Michael Brown. Hey Michael, it's certainly been a busy week, isn't it? And it's likely to get busier.
Well, indeed. Very good afternoon, Jamaica. Good to be back. And you're absolutely right. We were all expecting next week to be the busy week with four policy decisions across G10 and earnings absolutely everywhere. But it seems like all of that has come a week early because this week has been just as hectic.
Indeed. You would almost say everything everywhere all at once.
Very much so.
To coin a Netflix film, and we'll certainly be talking about them later.
But, very good.
I thought I'd slip that one in. But anyway, markets slowly recovering their equilibrium, clawing back the losses that we saw 2 weeks ago in the wake of obviously that President Trump announcement of 100% tariffs on all Chinese goods. He's sort of stepping back a little bit, resiling back from that a little bit, I think, when he acknowledged that, or he admitted that no one really wants those tariffs. Well, I was about to say NSS. No kidding. But
steady.
Yeah, indeed. So I think the markets are pricing in a bit of a taco when it comes to that. But these trade tensions are still pretty much front and centre, and now they're affecting Europe as well. I
would say it's sort of evolving a little bit in line with how we expected. You know, the tariff threat came in, markets react to that in a knee-jerk risk-off fashion. The dust settles, it looks increasingly like a negotiating strategy, sentiment steadies as we've seen, but markets don't have conviction quite yet, at least not on Wall Street, to actually make new highs. Probably waiting for confirmation that it is a taco moment, at which point the rally then resumes in much more convincing fashion. But, you mentioned that there is trade uncertainty in Europe, which is true, but markets shrugging that off. I mean, look at the FTSE 100 at a record high.
Yeah, indeed. Just stealing my thunder a little bit there, but that's fine.
Sorry, mate.
Companies are still reporting, and companies as well are, I think, reporting fairly decent quarterly numbers, with the odd exception. So that's certainly not hurting sentiment either. And as you say, FTSE 100 currently trading just below 9,600. So all appears to be right with the world. But before we move on and get through what is going to be a packed calendar of content today,
indeed,
let's do the risk warning. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own advice. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 72% of retail investor accounts lose money when trading spread bets and CFDs with this provider. Okay, so, there's a number of, tangible factors driving markets this week. Obviously, we talked about them: strong earnings, a possibility of a taco. Trump always chickens out, for those of you who don't know what that means.
We're not talking about Mexican food, don't worry.
No, we're not. Also, obviously, there are trade tensions now in Europe after the Dutch government removed the Chinese leadership of Nexperia in their Dutch head office. Took control of the chip maker, which prompted retaliation from China in terms of suspending chip shipments to European automakers, and now there's a shortage. And maybe there's a lesson there. Maybe don't put all your eggs in one basket when it comes to chipsets which you put on circuit boards for things like electric windows, dials and other dashboard functions.
Yeah, probably wasn't the wisest move, that one, was it? Let's be honest.
Indeed. Anyway, so FTSE 100, as we mentioned, posting new record highs today. Decent earnings updates from the likes of London Stock Exchange, Unilever and Lloyds, as well as Barclays earlier in the week. BP and Shell are getting a fairly decent lift as well on the back of that rebound in oil prices after those new sanctions on Rosneft and Lukoil. Beyond Meat is back in the headlines.
Oh, God.
Again, meme stocks up over 1,000% this week at one point, after I think Wall Street Bets and Reddit traders decided to do a GameStop style short squeeze on short sellers.
Yeah, I saw at some point, I think before all this kicked off, I think about 65% of the stock was sold short. So that's exactly what's happened. And what are we now? 4.5 years on from that initial sort of meme stock frenzy. It just makes me chuckle a little bit because, at the same time as you've got basically worthless companies being pumped 1,000% by a few people on Reddit, you've got officials at the Fed running around going, yes, monetary policy is restrictive. Not sure about that one, lads, if I'm being completely honest with you, when you see markets doing this sort of thing.
Indeed. I mean, basically, it went from 64 cents at the end of last week to as high as $7.68 before slipping back again.
Well, we've opened at about $2 this morning, so...
Well, that's going to be brutal if you're leveraged. But slightly off topic, or we were dealing, sort of delving into this. You say 65% short interest. That's still below 100. And GameStop was about 400% short interest.
Yeah, it was at one point, wasn't it?
Yeah, exactly. And that was one of the reasons why GameStop rallied so aggressively, because the short interest was well and above the entire market capitalisation.
Yeah, it's impossible to cover your positions.
Yeah, exactly. So that sort of explains that. 1,000% increase on a 65% short interest seems a little bit odd and bizarre. Anyway. Gold's also come off in the last couple of days, only modestly.
Lost its shine.
Oh God! people. I should get my red card out again. I really should.
I think you should.
but I appear to have mislaid it. Actually, I think I got told not to use them because it started to get a little bit boring. Anyway, it lost its luster a little bit, along with silver, but. I think when you've seen the sort of gains that you've seen in gold this year, the modest decline that we've seen so far, it's not really that unexpected. Anyway, talk about that a little bit. Going to go on to UK markets, talk about the UK data this week, CPI, whether it makes a Bank of England rate cut this year more or less likely. I still have my doubts about that. Then we're going to go on to Barclays' third quarter results, Lloyd's third quarter results, Unilever. We'll talk about the profit warning briefly from B&M European Retail and the share price reaction to that, which seems to me, on the face of it, to be slightly outsized relative to the adjustment to the EBITDA. Then we'll talk about Netflix and Tesla's third quarter numbers before we look forward to next week in the Fed meeting, the ECB, a good proportion of the Magnificent Seven, Apple, Amazon, Microsoft, Alphabet, Meta, all of their latest earnings announcements, along with HSBC and Next. So that's quite a significant topic board, if you like. So let's start with UK CPI, given the fact that we've got the budget coming up. We've seen gilt yields soften on the back of those CPI numbers, 3.8%. Good news on the face of it. Certainly, I think, decreased the pressure on Rachel Reeves. But does it mean that we're going to get a rate cut this year?
I would say that's still very, very doubtful. Before I get on to that, I'm loath to say that it's good news. I would say it's sort of less bad news. Inflation is still running at, as near as makes no difference, double the Bank of England's 2% target. It just wasn't quite as high as the 4% that markets had expected it to be. But still, 3.8% on your headline inflation and 4.7% on the services metric. I think we should probably keep the champagne on ice for the time being. The market, as you said, has repriced its expectations dovishly in terms of BOE policy. I think we've got about a 3 in 4 chance now implied of a rate cut by the December meeting. I still see that as unlikely, to be honest. I think the MPC are clearly very, very split in terms of how they view the economy. You've got 4 policymakers who are focused on the risk of inflation persistence, which that services CPI metric would say there is a big risk of inflation persistence. You've got another group on the MPC who are much more focused on the degree of slack opening up in the labour market. I think they're not going to go in November. They're not going to go before the budget. December, maybe, but the problem with the December meeting is
Depends on the budget, I guess.
Firstly, it depends on the budget. Secondly, there's no forecasts. There's no press conference. And we know the BOE are sort of loath to move when they don't have anything to explain their decisions. So my assumption is that we are now on hold until February of 2026, February next year. That's when we'll get another 25 basis point cut. But what I think has been interesting this week isn't just the rally that we've seen in gilts and yields falling across the curve. It's that actually gilts have been outperforming their peers. So the spread on the 10-year gilt over the 10-year Treasury yield, that was up at about 60, 65 basis points a fortnight ago. That's now down at about 40 basis points. So that, I think, is, if Rachel Reeves is looking at her Bloomberg terminal and wanting a bit of a confidence boost,
assuming she's got one.
Well, which she doesn't. I know she doesn't. That's the real signal that the market is becoming less jittery on the fiscal front, I think.
I do find it strange that the UK government can't afford to have a Bloomberg terminal for its Chancellor of the Exchequer, and yet they can spaff stupid money on pet projects that ultimately offer nothing to the taxpayer as a whole. But that's that's a completely different rabbit hole, and I'm not going to go down there. But yeah, I mean, sticky inflation, and I think that's the key. I think you hit the nail on the head there. Service inflation is still at 4.7%. Core inflation is still at 3.5%. And we all know that core inflation is probably the stickiest of all the inflation metrics.
Yeah, absolutely. And even some of the inflation components. I mean, I think, food prices rose by 4.5%. Clearly that's better than the 5% that they have been rising at for the last few months. But it's still 4.5%. And I think a little bit of this context is being lost, where inflation has been relatively high for relatively long, that I think people are getting a little bit overexcited about what is ultimately still a pretty hot CPI report. It's just not as hot or not as bad as it could have been. And the other thing in terms of inflation is not only is persistent inflation, not only are those underlying metrics still relatively firm, but earnings growth is running at 4.5-5% as well, and that's not compatible with a return to the 2% target over the medium term. So I think it's far too early to be sort of signalling the all clear just on the back of this one data point.
And I think if you've only got to walk around a supermarket to know that inflation is sticky. We've all noticed it. Prices may not be going up, okay, but we're getting smaller sizes and weights for the same price.
Yeah.
I noticed it the other day. Instead of getting 250 grams of butter, you're now getting 200 grams of butter for the same price.
Which
but
is
essentially,
shrinkflation.
It's in shrinkflation, but it's also a 20% increase in price.
Yeah.
And you're getting essentially less butter. Or you're getting, instead of a 6-packet of Walker's crisps, you're now getting a 5-packet. Walker's crisps for the same price.
There's still a lot of that going on. And of course, there are still upside inflation risks, whether they be within the economy, domestic, homegrown, either in terms of the labour market that we just mentioned, or goodness only knows what's coming in terms of the budget at the end of the month. I think end of next month, the Treasury are flying every trial balloon they can possibly find at this point to see what might land, but also externally as well. There's been a lot of reports this week around, again, food prices, particularly in terms of beef, and also obviously crude, which has rallied 5% or so over the last 24 hours at the time of recording. And if that is sustained, that could then provide an inflationary impulse as well. So I think we can be maybe cautiously optimistic that we might be past the peak. The question then becomes, how quickly do we get back to 2%? And I think it could be a hell of a long time until we do.
Yeah, and it was fuel prices that actually exerted upward pressure on inflation in September. And obviously today's rise in crude prices is not going to improve that.
Not
anyway,
at all.
Producer prices made a comeback, Michael.
Oh, yeah. Unexpectedly.
What do they tell us about future inflation expectations? Anything?
Well, do you know what? I don't wish to be uncharitable to the ONS, but I would be completely honest to say I don't think they tell us anything. I think there's probably two reasons for that. One is because we are shall we say, concerned about the quality of the data. The second is that the correlation between that and CPI has actually been pretty loose for a while now. But if you do look at the PPI in isolation, certainly in terms of output prices, the trend is a very, very worrying one, because I think we've had 6 or 7 months now where PPI has been increasing month on month, which is clearly, when we're talking about how quickly are we going to get back to 2%, well, factory gate prices are moving in completely and utterly the wrong direction.
Yeah, and I think the PMIs have sort of been bearing that out anyway, haven't they?
Yes, they have, yeah.
Yeah, so confirmation there. Or you could even say it's confirmation bias. But the data is the data. We also have public sector borrowing. Not a pretty picture.
No, it was utterly grim, to be completely honest with you. Whichever way you try and cut the figures, it was horrible. Borrowing was as near as makes no difference 100 billion in the first 6 months of the financial year, which, when you take 2020 out of the data, and of course there was this small thing called a pandemic, it is, as you say, a record. And, everywhere you look, it's grim. The deficit is, I think, 17% wider than it was this time last year. It's 7 billion above the OBR's forecast. So that's Rachel Reeves' headroom gone before anything else is accounted for in the model. And I think government spending is up by about 13-14% year on year. Again, I'm not sure this tells us anything new. It just confirms what we already knew, which is that the fiscal trajectory is frankly staggering and clearly unsustainable.
It's worrying, I think, to maybe underplay it slightly. We'll have to see what the budget brings, but I can't say I'm optimistic. Anyway, let's move on. I think we've depressed ourselves enough. Let's move on to something.
We really have.
Let's move on to something much more encouraging, and it's the performance of UK banking shares.
Yes.
Obviously, we talked about this last week, the US auto loan problem, and the fact that last Friday there was concerns about that prompted a sharp fall pretty much across the board in banking share prices, not only in the US but here in the UK. God knows why, given the fact that I would imagine that even UK banks' exposure to the US auto loan sector is probably going to be fairly minimal.
It was bizarre. I think it was a case of sell banks, ask questions later.
Yeah. Anyway, Barclays came out and they basically recovered all the losses that we saw last Friday, and they're actually now up from where they closed last Friday. Decent rebound, solid Q3 numbers, profit before tax, £2.1 billion, slightly below expectation. So that's year-to-date profits of 7.3 billion. Raised its guidance. And they did actually take an additional charge on the UK motor finance provision, increasing it by 325 million. That's quite a sizable increase from 90 million pounds.
I was going to say, they were one of the few banks that hadn't really set aside particularly much on that front. So maybe there's a bit of catch-up going on that front. But that was a bit surprising. I don't think that takes too much shine off the figures, though, to be completely honest.
They also took a provision of 110 million on Tricolor.
Yes.
In the same way that JP Morgan did. But again, investors don't seem to care.
Well, but also I think, and I know Jamie Dimon's been running around talking about cockroaches to everyone who'll listen over the last week, which has been winding me the hell up. But
it's a great analogy, isn't it?
It's bloody annoying is what it is. But I think actually the market is very much looking at this as a case of, fine, they are taking these provisions. It looks idiosyncratic. It doesn't look systemic, which hopefully doesn't come back to haunt me. And also these banks have very, very resilient balance sheets, which actually enable them to take these provisions and get ahead of things. I don't think it's a sort of canary in the coal mine for a wider problem. I think that's very much the market's view on this at the moment is, we're sort of forewarned is forearmed, and that's the way the banks are approaching things.
Yeah. And they did announce a £500 million share buyback with further distributions to be announced on a quarterly basis. So the prospects for Barclays look fairly decent. They're retesting those September highs of around about 390p, just below that as I'm speaking. So it'll be interesting to see whether or not it's able to take out those highs and push up to £4.
Indeed.
Barclays, good results. Let's move on to Lloyds. And
yes.
Lloyds, again, saw a sharp share price fall at the beginning of the week, or the end of last week rather, on the back of these US auto loan concerns. Again, Lloyds Banking Group
Bizarre.
is a UK bank.
Bizarre.
It's got no US exposure at all. And yet here we are. We're now back where we were, pretty much retesting the highs of earlier this month. Decent set of numbers. Easy for me to say. Despite a fall in quarterly profits, and we know why there was a fall in quarterly profits, because they announced the increase in provisions earlier this month.
Yeah, not a surprise to the market at all. They came back and they said, they've upped that provision. We knew that. That was, again, forewarned on that front. So why do we need to react to that in the earnings report? And again, everything's looking all right. And
this is an interesting one. Net interest margin for Q3 was at 3.06%. A year ago, it was 2.94%. And rates are lower.
I was going to say, tell me in which direction rates have moved. What's happened there?
Yeah, exactly. And certainly looking at their balance sheet, loans to customers holding up well, up 6.1 billion over the quarter, and deposits are also up over the quarter by about 2.8 billion. So there's no sign at the moment of strain on customer finances. Certainly not judging by the, certainly not judging by both sides of the bank balance sheet.
Yeah, and actually that's really, I think, the thing that we're looking for in those Lloyd's results is, can it tell us anything about the state and the health of the UK consumer? And according to the data and according to the earnings, all looks okay.
It does, and the market continues to trend higher for Lloyd's. It'd be interesting to see whether or not we're able to take out those highs that we posted back in the start of October at around about 86.5p. Not far away from that now, around about 85.7. So again, a decent set of banking numbers from Lloyd's. Unilever. We all know that Unilever has been struggling for some time when it comes to its sales growth, but it does appear to be turning a corner. It's looking to spin off its Magnum ice cream brand later this year. That's been delayed, however, by the US government shutdown. Don't say it. Don't say it. You've got to say it now, because
I was going to say, because people are going to be like, what's he on about? When we were doing our rehearsal for this podcast, which we do every week, I said that the Magnum IPO is melting away into the distance, which was a terrible pun that I was told not to repeat, but now I've had to.
You've had to, indeed. So the reason it's been delayed is because they can't get the paperwork signed off by the US government because of the US government shutdown. So the hope is that it will basically get finalised before the end of this year, once the US government reopens. But it's going to be an Amsterdam IPO with secondary listings in London and New York.
Which we've discussed before is clearly not particularly great for the London market. But also, all well and good saying should complete in Q4 when the US government reopens. We are on day 23 of the government shutdown and the two sides aren't even talking to each other. So I feel like that might be overly optimistic at this point.
It could be, but certainly I think the separation is continuing apace, and it's ahead of its schedule. The company Unilever is ahead of its schedule to save €800 million by the end of next year. So it's been broadly welcomed, today's results, and also noted that currency effects actually knocked a hell of a lot of knocked an awful lot off its profitability. That's what I was looking to say.
Yes, there we go. You got there in the end.
I got there in the end. I had a bit of a roadblock in the brain. Yeah, I mean, basically they cited currency effect for a 6% impact on profits.
This always annoys me.
That's huge. That's huge.
Well, it is huge, especially when the market hasn't really moved that much all year. But all of this always really annoys me. I think the
euro is higher. Okay, the euro is higher, but I mean, it's not as if it's unexpected.
Yeah, but also this, again, one, it's not a huge move. Two, it always winds me up, and I think it's because I started my career in the FX space. But it's almost verging on negligence. You've got currency risk. Do something to manage it. It's not exactly rocket science.
Well, you say that. It took Netflix about 7 or 8 years before they started to hedge their exchange.
Well, yeah, I remember we had that discussion recently, actually. I just always find it mind-boggling, to be frank.
Now look at them. Anyway, we'll come on to them in a minute. B&M European Retail this week issued a profits warning. Earlier this month, they reported that their EBITDA forecast for H1 should have been lower. They revised it down from 198 million to 191 million. So £7 million. The share price dropped 25%. Which is ridiculous. I mean, the share price is already at multi-year lows. They kept their 4-year outlook unchanged, and the CFO has resigned. So, that makes no sense to me.
In the grand scheme, £7 million, it's a lot of cash, right? If there was a briefcase over there with it in it, I wouldn't say no to it. But in the grand scheme of things, for the company, it's a rounding error, I would argue. It certainly shouldn't be a catalyst for that big of a decline in the share price. It's a bit of a head scratcher as to why it was. I mean, maybe it just speaks to how fragile a view the market has of how the company's operating. But as we were discussing earlier, it is starting to slowly but surely chip away at some of those declines. So maybe the dip buyers are out in force and realising that is indeed overdone.
Well, it dropped from 217p. It made a low of 162p. It's now above 180p. So there's still a big gap between 180p and 215p.
Yeah, there's a hell of a long way to go there, isn't there? And actually, that decline was what? I'm just trying to get it on my chart here. Lowest level since 2014, I believe.
Yeah. So
the low that we printed. That is.
I think when you're looking at B&M, and if you're a shareholder in B&M, the question you need to ask yourself is, how much lower can it go? Is all the bad news priced in? And ultimately, do you feel optimistic about the long-term prospects of the business? Certainly management appear to be, because they're still opening new stores.
Yeah, I think the only thing that could help explain that decline is the market almost asking what next. In terms of, you've announced this accounting error, blunder, mistake, whatever you want to call it. Is it a one-off, or are there more sort of skeletons lurking in that closet that either they don't know about or that they are going to inform us of at some point in the future, which may have triggered that decline? But as you say, management seem, at least on the face of it, pretty optimistic.
Okay, so let's move on to this week's two big US earnings announcements. Let's start with Netflix. I'm going to pose a question to you, Michael.
Go on.
Have we hit peak Netflix?
Well, do you know what? You've written that in your note here, and I wrote next to it in my scribbly handwriting, how many times have we heard that before? Maybe we have. I would actually I'm going to respond to a question with a question. Have we hit peak streaming? Because, actually, one of the things that was, the big growth driver for the streaming space, and Netflix in particular, obviously COVID drove a big part of it, but was this switch away from what you would call linear TV to streaming platforms. Nowadays, I think probably everyone has at least one of these platforms, if not about 4 or 5 of them, and is paying quite a lot every month for the privilege. Where are new subscribers going to be coming from? And I know Netflix don't report subscriber numbers quarterly anymore, but where is the growth coming from? Because as far as I can sort of work out, the new accounts are almost just being recycled among all of the streaming services. Someone will have a Netflix account for 3 months, then watch everything on there, go and get a Hulu account, a Disney Plus account, and just this sort of cycle. So, yeah, I think the question is, where is the growth going to come from? And I don't really see an obvious answer to that.
Yeah, it's the churn rate. I mean, I think in terms of the churn rate in the UK and the US, the markets are pretty saturated. So any new subscribers there, you're probably going to get at the expense of somebody else. I think Netflix's biggest market, is probably, or in terms of growth, is probably going to be Latin America, because they do an awful lot of what I would call foreign language content.
Yes.
So I think certainly in terms of growth areas there, they have an advantage on all of their peers because of the fact that they do an awful lot of foreign language content.
Yeah.
They certainly do appear optimistic about guidance for Q4. They expect revenues to be 11.96 billion or 12 billion, less a little bit of change. They've obviously got some new content coming out. The final part of Stranger Things,
yes,
which will be eagerly awaited. Trouble is, they're not kids anymore. They're about in their 30s now.
That's a very good point.
So it'll be interesting to see whether or not that's as good as it's hyped up to be, because me and the wife have seen all of them. Obviously, they got the latest version of The Witcher, minus Henry Cavill. I expect that to be rubbish, but I remain to be surprised on that.
Mr. Optimistic over there.
Along with the new Knives Out sequel with Daniel Craig. So certainly I think operating margins have taken a hit and expected to fall further in Q4. So that'll be interesting as well. But they still expect to see $45.1 billion in full-year revenue, which is at the top end of its forecast. Investors don't seem that impressed. It's currently, the share price, sitting on its 200-day moving average.
Which, even for a technical analysis heathen like myself, I will give you that is a very, very key level indeed. We are still up by 25% on the year. I think the problem for Netflix is we haven't really gone anywhere since July, when they last updated earnings. We've been in a very, very tight range since that period, and actually it looks like we're just starting to break to the downside of that range now. But the stock just hasn't gone anywhere for 3 or 4 months. And if something doesn't go up, then it's only one way for it to go.
It'll roll over.
Yeah.
It's broken below the August lows. It's broken below the October lows. The next target is the May lows.
Yes.
So, which is just around 1,100.
Yeah. And it wouldn't be that surprising if we did decline to that point. The only thing I would say about Netflix, just lastly, is that there was a bit of a skew, and I think you touched on this in terms of the 600 million Brazil tax payment that did skew the numbers lower a little bit, but fundamentally I think there's bigger issues at play than that.
No, absolutely. And there has been some chat that Netflix could be interesting in buying some assets owned by Warner Brothers Discovery. So certainly it's adding value to its proposition as a better use of cash than large-scale buybacks.
Yes,
which they've been doing since July, and which have added the sum total of nothing to the record highs that we saw since then. So.
And that is a sort of perennial pet peeve of both of ours, actually, isn't it? The bloody buybacks that stock companies go on.
It's a nonsense. Tesla's results also significantly underwhelming.
Yeah.
But not really much of a share price reaction. They're 2% lower today, but they're still above the lows of this month. So it'll be interesting to see whether or not they're able to hold above those lows. There was no surprises there, was there?
No, not at all. And revenue was higher, but we knew revenue was going to be higher. Obviously, we had the delivery numbers already. There was this huge amount of demand that was pulled forward into the third quarter for all EV manufacturers, not just Tesla, as a result of these expiring tax credits in the United States. Really, really not a lot to surprise in Tesla's report yesterday. I think the comments that we made after the delivery numbers a couple of weeks ago really still stand, in that, what is the plan now that tax credit isn't there. They seem to be going down the price route in terms of this more affordable Model 3 and Model Y that they've been launching. I don't think the market's taken that particularly favourably. I think the question really now is what's next for Tesla? What are you going to do to increase and keep demand underpinned now that your vehicles are mechanically more expensive than they were 3 weeks ago?
I mean, operating margins, I did notice that obviously they were lower than the same quarter last year to the tune of 501 basis points at 5.8%, but they're the highest this fiscal year. So even though they're lower than they were 12 months ago, they've improved from Q1 to Q2 to now.
Yeah. So
it'll be interesting to see whether or not they can maintain that trend going forward. But that hasn't changed the fact that net income was still down by 37%. And Musk was at pains to actually mention higher tariffs, which was one of the reasons as to why net income was down to the tune of $400 million, actually, was the tariff effect. So I'm wondering how well that will go down with certain person in the White House.
I was going to say that bromance is well and truly over, I think, isn't it?
Indeed. I mean, one thing that did strike me, they were very woolly on the outlook.
Yeah.
They didn't really give one.
I guess, again, that might not be too surprising, given what we were just discussing in terms of where the hell are you going to get demand from, and all of the tariff uncertainty and everything else. Then, it probably is a little bit difficult for them to give an outlook, but that may explain away some of the downside that we've seen in the stock as well. The lack of confidence from the firm to actually tell us what they think is going to happen. And as you say, they're down about 3.5% now.
Yeah. Okay, so let's move on to next week.
Busy week.
Busy week. Let's start with the Fed and the ECB. I think that's probably the easiest place to start. Obviously, we've got CPI out of the US tomorrow. I don't think it's really going to make any difference with respect to what the Fed may or may not do next week. I think I think it's pretty much set, unless there's a real outside surprise.
I would agree with that. I think, the numbers will probably be out by the time you listen to this, but we are expecting headline and core CPI at 3.1% year on year, both of those numbers. But the Fed have been very, very clear that their reaction function, in other words, what they're focused on, is supporting the labour market. They're going to be looking through inflation, especially tariff-induced inflation, as this one-time shift in the price level. And as a result of that, I'm with you. I don't think the data is really going to deter them from making a 25 basis point cut next week and doing the same thing in December as well, you'd expect.
Yeah, I mean, Governor Waller, who's broke cover, I think, a couple of weeks ago for the first time since the last meeting, he's been at pains to suggest caution when it comes to further rate cuts. That's not to say that he's ruling them out. He's not. I think we're going to get one. And it's not as if they don't have other data to work from. ADP, and ISM reports, though I think there was a report that I read somewhere that ADP may not be supplying any more data to the Fed or something. Yeah,
I didn't quite understand that report. I will be completely honest with you. I don't know.
Why would they do that? Well, why would they not do that?
Yeah, I'm also not entirely sure whether the ADP was supplying, additional data to the FOMC that wasn't released publicly, or whether it was something to do with advanced side of the data. I'm really not too sure, to be completely honest with you. But there's clearly been some sort of falling out there. But it doesn't matter overall. I mean, as you said, there is enough other data out there. And also Jay Powell himself, when we heard from the Fed chair a week or so ago, he stood up and went, nothing's really changed in the last 6 weeks since our September meeting, which is about as plain a way of saying we are going to cut rates as you're ever going to hear from him. I wouldn't be surprised if actually the big interest around the FOMC meeting is in terms of the balance sheet, because obviously we are seeing some tightness coming through in funding markets, in money markets in the United States. The Fed are letting treasuries roll off their balance sheet. I would expect that they probably want to wait until the end of the year to bring the quantitative tightening process to an end, but there is potentially a chance that they do call time on things as soon as next week if they do want to get ahead of any potential sort of issues in those funding markets.
I think given some of the uncertainty around the US banking system, particularly the mid-tier banking system, they might want to do that. Yeah,
it wouldn't be a surprise if they did, to be honest. And then of course the conversation moves to when do they start purchasing treasuries to keep the balance sheets at the same size.
Do you think that they will signal a December rate cut as well, or will they keep that? Will they keep that decision? Keep the markets,
keep it live. I to be honest, I wrote up a preview of this week. I would not be at all surprised if the policy statement is exactly the same as the one they issued in September. Just change the date on it. They are going to stay in this ostensibly data dependent mode, but when you've got a US government shutdown, so no one's getting any data, and a market that is fully pricing in 2 rate cuts by the end of the year, you really don't want to rock that boat too much, I don't think.
So basically status quo.
Absolutely. And status quo with Stephen Myron being a puppet for his boss and voting for at least a 50 basis point cut, if not more.
Yeah. Okay. ECB, European Central Bank, not the English Cricket Board.
So I've got some paint to watch dry instead. I think that's going to be more interesting than the ECB next Thursday.
There has been some toing and froing suggesting that no more rate cuts, or we may retain the option to cut further. But inflation in the EU is starting to edge higher again.
It is, yeah, and actually CPI in September was north of 2% for the first time since April, I believe. Rather unhelpfully, the October CPI numbers are released on the same day as the ECB announced policy, so I'm not entirely sure who was coordinating that one. But yeah, I think it's going to be very, very dull. They will keep policy on hold. They'll repeat this usual stance of we're data dependent, we're going to take a meeting by meeting approach, etc., etc. I think the December meeting could be a lot more interesting from the ECB. We get another round of forecasts at that meeting. And of course, the September forecast pointed to an inflation undershoot in 2026 and in 2027. So there is an argument that if you have a more sustained or even a larger undershoot of that inflation target in the next forecast round, then perhaps some of the doves will look to push for another rate cut. But I think fundamentally my expectation is that the ECB are probably done and dusted and are just going to hold the deposit rate steady, well, certainly for the rest of this year and probably most of next year, if not all of next year as well.
All right, let's move on to HSBC's quarterly earnings, which are, I think, due out on the 28th of October. Obviously, we've seen their share price fall back from the peaks earlier this month on the back of that report that they're going to be taking over the remaining stake of Hang Seng, suspending buybacks for the next 3 to 4 quarters.
Yes,
which has prompted the share price to drop quite sharply below £10. It's struggling to get back above there at the moment, but you know, I'm looking at HSBC's numbers, Michael, and I've got to say there's nothing there that suggests that we're going to get any surprises next week.
No. Which probably means that we will now. But no, I completely agree with you. And also, obviously, you've got the read across from not only the UK bank earnings that we had this week, but also the earnings that we had on Wall Street last week. The banking sector seems to be doing very, very well at this moment in time. And, you know, you would strongly expect that HSBC will follow suit on that front.
I think the elephant in the room, as far as HSBC is concerned, and I think it's symptomatic of the fall that we saw in the share price on the back of that announcement, is obviously the Hong Kong real estate sector. They were already taking provision for losses even before they took the remaining stake in Hang Seng.
Yes.
And I think as you go forward, I think investors will be looking to see whether or not they crystallise any further provisions in respect of Hang Seng now that they've taken over the whole bank.
Yeah, I think that's...
take over the whole bank.
Yeah, I think you're right. That's certainly the factor to watch next week.
I mean, I think when I'm just looking through my notes here, they set aside an average gross loans to be around 40 basis points in 2025 due to weakness in the Hong Kong real estate sector. So, yeah, I mean, the big question is, do they raise that from 40 basis points to higher?
Yeah. And if they do raise it, of course, the question then is how much higher do they raise it?
Yeah. So but I think that's going to be the interesting one when we look at HSBC's results next week. It's not so much the decline in profits, which we're probably going to get, because we also saw a decline in profits in the UK bank as well.
Yeah.
It's whether or not, it's how much they raise their provisions for. In the same way that Barclays and Lloyds have done for entirely different reasons.
Yeah, exactly that. Very different reasons, but provisions being raised nonetheless.
Yeah. Okay. Let's talk UK retail. Next.
Yes, next. Next up.
Next up is next.
It's getting worse.
It is, isn't it? Their shares are at record highs. Again, they hit record highs in May, June. They, again, raised their guidance back at the end of July, albeit very modestly. And now the shares are above £13. So, what can we expect to see from next?
Well, it's that perennial question again, isn't it? Are they going to raise their guidance? That is the trademark of the stock, is deliver solid results, raise your guidance and set the bar even higher for the next quarter. So that is really what participants are going to be focused on. Do we get that yet again? You would argue to some degree that the stock is almost priced for perfection. As you say, we are trading at record highs. So I think if there is any negative surprises or negative lines in the earnings report, then the market is going to take a very, very dim view of that, purely because of how optimistic we are at the moment. But on a broader level, of course, we'll be looking at a read on the UK consumer at large, particularly as we move into the labour market loosening, as we said, but also the budget coming up, and whether Next have anything to say about that.
They have sort of set the scene for the second half of the year already. At the end of second quarter, they raised their full year guidance for profit before tax to £1.1 billion. But on their UK numbers, Next was a lot more cautious on H2 than it was on H1. They're saying that UK guidance for sales for H2 is only 1.9% versus 7.6% in the first half, and that consumer spending is expected to slow materially in H2. Having said that, the international business appears to be doing very well indeed. So maybe there's a bit of an offset there.
Yeah, potentially. That split will be worth keeping a very, very close eye on, though.
Certainly it does, because I think one of the trends I've noticed in the UK has been a slight softening, whereas international's been doing fairly well.
Yeah.
Okay, Shell. Third quarter numbers. We've seen a bit of a boost to both Shell and BP's share price recently. And actually, Shell's share price has jumped back to levels last seen in March this year. In fact, to the highest levels this year, on the back of the sharp jump in oil prices that we've seen over the past couple of days.
Yeah, I was going to say, it does, just before we get on to Shell, it does sort of almost feel as if crude is putting in a bit of a bottom. Not only have you had this big kick higher on the back of the latest round of Russian sanctions, but the US have also come in and said they're going to start filling up the SPR. It just feels as if the tide is starting to turn a little bit once more.
Well, if you look at a chart of Brent crude, you will see that every time we've got to around about $60 a barrel. Yeah, it's a huge level, isn't it? We've bounced. So you could conceivably argue that there is a bit of a base there, and ideally, I think that's where OPEC wants to keep it.
Yeah, you would certainly expect so, and it does look like things are basing out. Which, if that is indeed the case, and of course we can't say that after 2 days, we have to give that a bit of time. Then that could indeed be a tailwind for these commodity names like Shell and like BP.
It's also bad news for inflation, though.
Well, very bad news for inflation. Not that we need any more bad news on that front, of course.
And WTI, there appears to be a bit of a base at $56 a barrel as well. So yeah, it's there or thereabouts, between $55 and $60 a barrel. Generally, I would admit that's the preferred base for an awful lot of the oil-producing companies. Yeah, very much seems to be the case. And I've already noticed that petrol prices are already starting to go up again. Well, not that they need any excuse to put petrol prices up, do they? No, that is very true. One of the things Shell has been doing well, though, is that they're committed to obviously maintaining their buyback program, but they've been investing in oil and gas assets. Yeah. And getting rid of renewables. Which is exactly what an oil and gas company should be doing. So if you're sat in the offices at BP, take some notes, please. Yeah, because you're about 2 or 3 years behind. Yeah, exactly that. And you're now playing a game of catch-up, which you're not playing a game very well. And they have set the bar for Q3 quite high, because earlier this month they said in their trading update that it expects a significantly higher trading performance in its gas business, raising its production outlook for LNG to a range of 7 million to 7.4 million metric tonnes. And obviously they've also spent quite a bit of money on investing in LNG assets in Nigeria as well. So that should start to pay off over the course of the next few quarters as well. Okay, let's move on to the US companies now. And we're going to start with... Oh, it's a big week. It's a big week. We've got Microsoft, Apple, Meta and Amazon. Microsoft and Meta are on the 29th, and Apple and Amazon are on the 30th, assuming my dates are correct, and they haven't changed.
Well, and we've got Microsoft on the 29th as well.
Yes. Did I not say that?
Oh, you
Sorry.
may have done. Sorry, I may have missed that. Don't worry.
Oh, no, we've got Alphabet as well on the 29th.
Oh, it was Alphabet you missed. Yeah, there we go.
Yeah.
There's too much going on, mate.
There is. I mean, I don't know where to start. Actually, should we start with Amazon? Because obviously there was after Monday, there was that cloud outage. And I wrote a piece on my Substack about that. And I think one of the things I took away from that was that there is an economic stability risk here when it comes to all of these companies, different companies, using cloud services or contracting out their IT, their IT infrastructure to a third party. You know, if you're a hacker, why target an individual company when you can target Amazon or Microsoft or Alphabet, those cloud services? You could bring the whole economy to its knees.
Yeah,
and
absolutely.
it raises another question about data, client data, consumer data. Now, individual companies all hold your data. Now, we as consumers assume that these companies are completely separate, but they're all holding their data
in the same place.
Or are they? I mean, what are the rules around client data and actually data that's secured on the cloud?
Yeah, well, I mean, I am certainly no expert on that, so I will leave that to the tech experts out there. But it is ultimately a really strong example and a really huge case of concentration risk. You are relying basically on this potential single point of failure for absolutely everything. To give you an idea in terms of this AWS outage on Monday, not only was it impacting things like, visiting websites, very, very basic stuff. There were issues with online banking. Personally speaking, I couldn't buy a coffee, or I might have bought the same coffee 6 times because I had to pay for it so many times before the card transaction went through. As you say, if you were a nefarious character or a bad actor of some description, then it would be relatively easy to bring the economy to its knees by targeting these companies. But it'll be interesting to see what, if anything, Amazon have to say about that in their earnings call next week.
I think so too, but it's not just Amazon we need to think about here. It's also Microsoft and Google, because they're the big 3 players. I mean, it's not as if there are an awful lot of small players. There are some, like Snowflake, for example. Yeah. But, for me, this is why I've always had a distrust of the cloud, because essentially what you're doing is you're contracting out your security risk to a third party.
Yeah, that's exactly what's going on.
Or backing up your data to a third party. Well, I don't do that.
No, it doesn't.
I don't do that. This is what I use to back up my data. It's all stored locally. I don't put anything in the cloud. And the thing is, the way software systems are set up, they encourage you to buy storage. Gmail does it. Google does it. Say, put 5 gig, buy 10 gig, pay X amount a month. Well, no, why? Because if you can't keep it secure, is it mine or is it yours?
Well, exactly. And also those data subscriptions are cheap enough that you just do it. You don't think about it. 50p
but they all mount
for...
out.
Yeah, oh yeah, very much so. Like the streaming companies that we were talking about earlier.
Yeah. Anyway, so Amazon, their second quarter numbers, the shares fell quite sharply, and they've really been struggling. They haven't really taken out those August and September highs, $240. They've been trading in a bit of a range at the moment, and I can define that range quite precisely. It's about 210, 240. That's your range.
Yeah.
Q3 numbers, obviously, we've had a Prime Day since then.
Yes.
So it'll be interesting to see whether or not they're able to meet expectations when it comes to those particular numbers. But the expectation, I think, for Amazon is that, Q3, it is their Q3, isn't it?
It is, yes.
Yeah, the Q3. The Q4 tends to be their strongest quarter.
Yeah, well, it's a holiday quarter, isn't it?
Yeah.
You've got Thanksgiving in the States, you've got Christmas everywhere else. Guidance for that is going to be pivotal, I think. The other thing, I was looking at actually all of the Mag 7 stocks earlier on when I was doing some notes for the podcast. Amazon are basically flat year to date. They effectively haven't gone anywhere when you zoom out. The question you've got to sort of ask yourself is what's going to be the catalyst that gives the stock a kick to take its next leg higher?
Yeah, you did right. I didn't notice that, but yeah, you did.
No,
right.
I was surprised by it as well. When I was looking at it earlier, one of those where you're sort of like, oh, maybe I should check the chart just to make sure that that's actually correct. But yeah, just trod water for 10 months.
It's been down to 160. It's been up to 240, and it opened at around about 220, which is essentially where it is now.
Yeah.
On the other hand, Apple, which had been performing poorly, has seen a really strong rebound in the past couple of months.
Yeah, it has. And the latest helping hand in that rebound has been what, by all accounts, is incredibly solid demand for the new iPhones. At least the iPhone 17 and the 17 Pro and the Pro Max. The iPhone Air seems to have been a little bit of a flop because they seem to be pulling back on production of that model. But yeah, Apple seem, at least in the market's mind, to be turning things around, although they still have these issues in terms of AI, that they simply do not seem to be able to get it right, either in terms of the technology itself or in terms of the headcount. Almost every week it seems that one or two of their senior AI execs are leaving to go to Meta or Google or whoever. So I think that's still an area of concern, but it seems like things are going pretty well once again.
Yeah, $4 trillion.
Yeah.
They've just become the latest US company to hit a $4 trillion market cap. I think it's around about $260, so they briefly touched it before slipping lower. My colleague Jackson Wong has written a piece on the Good Money Guide website about Apple, so that might be worth a read. So, basically trot over there if you're interested. But in terms of their guidance for Q4, it was underwhelming. So I think that there's certainly potential for an upside surprise here.
Yes, indeed. And potentially an increase in that guidance as well to reflect the new product demand.
Yeah, and obviously the new iOS 26.
Yes.
Have you upgraded to that yet?
Of course I haven't. I'm probably on iOS 2 or something over here.
I think it's 17 point something. But I've upgraded to 26 on my iPad, but I haven't upgraded my wife's iPhone because I'm worried that it might completely slow it down.
Well, that tends to happen, doesn't it? So.
It does. But yeah, so expecting great things from Apple on the 30th and their Q4 numbers. But there's also the question of whether or not it's priced in. But one thing I will say is that the share price, it's held above its 50-day moving average pretty much since the beginning of August and has bounced off every single time it's dipped. So it'll be interesting to see whether that continues.
Definitely.
Okay, my favourite company, not Meta.
I knew that was coming.
Meta Platforms. What's to say about Meta? They've pretty much gone sideways for the past 4 or 5 months. Support around about 690, but hasn't really gone above 800. So that's been trading in a fairly tight range since June. Q3 they expect revenue of $47.5 billion and $50.5 billion, with total capex for 2025 revised up slightly on the lower boundary from $64 billion to $72 billion to $66 billion to $72 billion. So one of the key takeaways from the last set of results was these companies raised their capex spend on AI.
Yes. And that's obviously going to be in focus. Well, I think there's two things in focus because actually what was interesting was, as you said, they raised their capex, but it was almost a case of the higher they raise their capex guide, the more the market cheers it, which is usually the other way around. But also the market participants, as time goes on, will increasingly be looking at how that capex is being monetized in terms of sales and in terms of revenue. It's all well and good saying you're going to spend 30 billion or whatever it is on AI infrastructure, but what are you actually getting in terms of a return on that investment? That's going to become the question.
Sure. Last but not least, Microsoft. We saw record highs in July. Since then, the shares have pretty much traded sideways. I think the Magnificent Seven have pretty much traded sideways, pretty much all of them, since the summer.
Yeah, essentially, they have. Which is actually quite interesting because despite that, there are still daily articles being written about, the S&P being too concentrated in tech and it all being a bubble and all this sort of stuff. Well, go and look at a chart because actually the market rally over the last 4 months hasn't really involved these tech names.
So I'm looking at this. I think this is their Q1 numbers, isn't it?
It will be, yeah.
Yeah, so this is the Q1 numbers. But again, Azure guidance, Microsoft says it expects revenue of between $74.7 and $75.8 billion. Azure is expected to see a 37% increase in revenue. Be interesting to see whether or not Azure and Google's cloud service get any new business as a result of the Amazon outage.
Yeah, that will be an interesting one to see, actually, whether people start...
You won't see that immediately, but obviously over the course of the next 6 months you might.
Yeah, if people start to think that they should shift things around a little bit.
And they also said that they'll be spending $30 billion in the current quarter as it looks to build out its ability to power its AI services. So that pace, it's about $120 billion a year.
And it's only increasing as well.
Yeah. Okay. So, as I say, those shares have traded sideways for pretty much the last few months. And we're going to finish off with Alphabet, Google.
Yes.
Let's see what their shares have done over the course of the last few months. And I bet, blimey. Now, that is interesting.
They've bucked the trend.
They really have bucked the trend in the past few months. They've gone, they've not quite doubled from the lows in April, but they're not far off.
No, they're not. And I wonder the extent to which this almost stems from the fact that they spent basically the back end of 2024 and the early part of 2025 going nowhere. And now they're finally getting a kick higher as the company sort of goes from strength to strength. I think they're up by about 30% year to date, which is pretty damn good. But yeah, it is interesting that they are bucking that broader trend.
Cloud revenue is a big contributor to their Q2 numbers. It rose over 30%.
Yes.
To $13.6 billion. So that's an area to keep an eye out for. There is also an expectation that Q3 revenues could hit $100 billion for the first time. I mean, that's a lot of revenue.
It's an insane amount of revenue, isn't it?
Just for a quarter.
Yeah, exactly. This is not an annual figure; it's a quarterly figure. And of course, the other thing just to keep an eye on is ads. Just for a sort of broader read on the economy. Yeah,
in terms of is there a slowdown in ad spend because companies are cutting back on advertising spend?
Exactly that.
But Google search was solid in Q2. YouTube was solid in Q2. Q3. Guidance for AI capex, $85 billion. It was raised by $10 billion in Q2.
Yeah.
So, there's an awful lot to keep an eye out for when we look at these big tech numbers next week. And coming as they do alongside a Fed decision, it could be quite interesting.
Could be a bit of a spicy week, couldn't it?
Indeed. It'll keep you busy, won't it?
Can't wait, mate.
Well, at least your hair's not going grey, mate.
No, it's just falling out. I'd rather it went grey, to be honest. Shall we leave it there?
And on that bombshell, we'll leave it for this week. So thank you very much for listening, guys. We'll pick this up same time, same place next week when we'll probably have an awful lot more to talk about. Certainly when it comes to tech earnings.
Indeed.
Anyway, thanks a lot, and
bye
see you
for
next
now.
week.